Over the last year, we have heard a lot about the Federal Reserve, aka the Fed, in the context of rising interest rates. We hear about them raising interest rates in order to combat inflation. But what really is the Fed? How does it work? In today's video, we will do a primer on the Federal Reserve to provide some additional context on what the Fed is and how it works. Before we begin, please like this video and hit the subscribe button with notifications turned on so you will be the first to know about new content. Our mission at the Personal Finance and Investing channel is to empower people to achieve financial independence. Subscribing will help us achieve that goal. Now, let's get back to today's video. The Federal Reserve System, also known as the Fed, is the central bank of the United States. It is arguably the most powerful financial institution in the world. But what is it and how does it work? The Fed has control over the production and distribution of money and credit in the US, much like other central banks in other countries such as the Bank of England, the UK central bank. They are responsible for monetary policy, which is how central banks manage a country's overall money supply and the general economy. They also have regulation of member banks. There are seats for 7 governors of the Fed, and it also has responsibility for 12 regional Federal Reserve banks covering specific geographic areas of the United States. These regional banks are based in Boston, New York, Philadelphia, Cleveland, Richmond, Atlanta, Chicago, St. Louis, Minneapolis, Kansas City, Dallas, and San Francisco. The monetary policy that the Fed is responsible for has 2 goals: foster economic conditions to achieve stable prices, i.e. minimizing inflation, and maximizing stable employment. This so-called dual mandate comes from Congress. The Fed is renowned to be purely focused on monetary policy and not involved in government or politics. Their decisions do not have to be ratified by the president or any other government official, and so they are thus considered to be independent. How does the Fed accomplish their dual mandate of maximizing employment and stabilizing prices? This is done through what is known as the Federal Open Market Committee, or FOMC, which is the Federal Reserve's main monetary policy-making arm. The first tool in their tool belt is controlling the supply of money in the economy. They do this in 2 ways. First is the actual supply of paper money. The U.S. Treasury Department issues coins, and the Fed prints and manages paper money. However, paper money is a small percentage of the actual money flowing through the economy. The vast majority of money is digitally transmitted between financial institutions. The Fed increases the supply of money in the economy electronically. For example, if it wants to increase the money supply by $1 billion, it will buy $1 billion of Treasury bonds in the market and deposit that money into the reserves of its member banks. The member banks then lend that money to consumers and businesses at a profit, which puts $1 billion into general circulation. An example of this method of increasing the money supply is known as quantitative easing, or QE. This greater money supply creates liquidity and a lower cost of money, which has the tendency to reduce interest rates in the economy. Banks can lend more easily, and it is easier for consumers and businesses to get loans to then deploy their capital into the economy to stimulate growth and investment. Another term for this practice is that the Federal Reserve is increasing its balance sheet by buying treasuries to stimulate the economy. There is an opposite process that takes place after extended quantitative easing, which is known as quantitative tightening. This is when the Fed reduces its balance sheet by shrinking monetary reserves by selling treasury bonds or letting them mature and removing them from its cash balances. This removes money from the markets, reduces liquidity, and tends to have the effect of increasing interest rates. The second tool in the Fed's tool belt is to control the discount rate, or the interest rate at which banks borrow directly from the central bank, as well as the federal funds rate, which is the rate at which banks lend to each other overnight in order to maintain reserves. Simply put, the Fed can raise and lower interest rates. As of this writing, in October 2022, the Fed has raised the interest rate 5 times this year for a total of 300 basis points, or 3 full points. This has increased the typical 30-year fixed mortgage from 3.45% in January to 6.11% in September of 2022. This has been very painful for home buyers and anyone who needs a loan for their personal or business use. So why has the Fed done this? As we mentioned above, one of the Fed's mandates is to minimize inflation. The price of a product or service is influenced by both the supply and demand for that product or service. Inflation has been running incredibly high for more than a year now for several reasons. Challenges on the supply side, such as supply chain disruptions and shortages, as well as heavy pent-up demand as the world exits COVID, have pushed prices up significantly. The Fed has a mandate to combat inflation, so they could either attack it from the supply or the demand side. Their monetary policy tools described above don't have much of an impact on the supply side of the economy, meaning they can't build more semiconductor manufacturing and can't pump more oil out of the ground. Monetary policy primarily affects the demand side of the economy. Consumer demand has been high throughout the pandemic, and even after the majority of the effects of COVID have passed as the reopening of the economy has taken hold. The Fed is currently targeting this increased demand. By raising interest rates, they are seeking to reduce demand, which will put supply and demand more in balance, which will moderate price increases or inflation. The theory is that by making it more expensive to borrow money via loans, consumers will be less likely to spend as much money, which will reduce demand for goods and services to offset supply shortages. In short, the Fed is trying to slow the economy. There is some skepticism that this will work because there are other factors outside the Fed's control that affect the supply and demand in the economy. Examples include increased stimulus in the form of the Inflation Reduction Act and student loan relief programs will actually increase spending. Supply-side factors have a disproportionate impact on the prices and are more significant than the demand-side factors. For example, the war in Ukraine, global semiconductor shortages, etc. have had a huge impact on the supply of goods. Most people don't say it explicitly, but the Fed is attempting to achieve demand destruction in the U.S. economy in order to keep prices from rising much further. More and more analysts are predicting a recession in the U.S. in the next 6 to 12 months, which will likely lead to more layoffs and slower job growth, which ironically goes directly against the Fed's first mandate of maximizing stable employment. We live in a very challenging economic times where there are numerous factors affecting our economy. A lot of pressure is put on the central bank to solve all of our problems with monetary policy. However, there are significant limits to monetary policy, yet the Fed has to use their limited tools to achieve their mandate, which means they will continue to raise interest rates to reduce demand, which will likely lead to a recession, which will also likely increase unemployment. These are strange times we live in, but at least now you know how the Federal Reserve works. Let us know what you think in the comments section below. Also, let us know if you have specific questions or topics you want us to address in future videos. Don't forget to like this video and subscribe to our channel so we can help achieve our mission of empowering people to achieve financial independence. Thanks for watching, and we'll see you next time.